Ladies and gentlemen, good day and welcome to Fedbank Financial Service Limited Q4 FY24 earnings conference call hosted by Equirus Securities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing the star, then 0 on your touchtone phone. Please note that the conference is being recorded. I now hand the conference over to Mr. Shripal Doshi from Equirus Securities. Thank you and over to you, sir.
Thank you, Steve. Good afternoon, everyone. I welcome you all to the 4Q FY24 earnings conference call of Fedbank Financial Services. Today, we have the management team of Fedbank Financial Services represented by Mr. Anil Kothuri, MD and CEO, Mr. C.V. Ganesh, CFO, and Mr. Amit Singh, the Investor Relations team head. With this brief introduction, I will now hand over the call to Mr. Anil Kothuri and the management team for their opening remarks, post which we can open the floor for question and answer. Over to you, sir.
Thanks, Shripal. Good evening, everybody, and welcome. I hope you've had the opportunity to look at our results and our investor deck, which were uploaded about an hour and a half ago on our website as well as on the stock exchanges. This is a busy time of the year, and we've completed an active quarter in what has been a busy year. I'll just take you through the highlights of the quarter. We saw a strong AUM growth in the quarter, 14% increase over the quarter gone by. Our AUM closed at 12,191 crore rupees. This is up from 10,748 crore rupees at the end of Q3. Now, this happened on the back of disbursals of 4,337 crores. Okay? These disbursals are split as gold loan disbursals of 2,849 crores and installment loan disbursals of 1,488 crore rupees. So this takes disbursals for the year to 13,579 crores, of which 4,202 crores are installment loan disbursals. So this is the growth that we saw in Q4. I must particularly call out what happened to our gold loan business. The AUM there registered a 17% quarter-on-quarter increase. So we closed our gold AUM at 3,969 crore rupees. So that's 17% quarter-on-quarter and 33% year-on-year. The tonnage of our gold stands at upwards of 9.5 tons. The weight of gold that we have in our vaults is about 9.5 tons at this point in time. Now, on the back of all this, we recorded a net profit for the year of 244.7 crore rupees, and for Q4, it is 67.7 crores. So our profit for the year is up 36% over the previous financial year, and our profit for the quarter is up 73% year-on-year and 3% quarter-on-quarter. Our asset quality also improved during the quarter. We ended Q3 rather at about 2.2% GNPA, and Q4 we closed at 1.66% GNPA. Okay, so that's a reduction of 53 basis points over the quarter. Or in absolute terms, we reduced by about 29.3 crores. Now, this reduction of 29.3 crore rupees was largely owing to the fact that we sold a large NPA account to an ARC that was worth 23.9 crores. Okay, so 6 crore rupees is the reduction that we've seen over and above the ARC sale that we've done. The sale that we've done has been at whatever price that we've been carrying the asset at on our books. So there's been no gain or loss owing to that sale. It just deflated our GNP and released our capital. Now, the progress on our off-book strategy continued, and our off-book AUM went up from 17.4% the previous quarter to 18.7%. Now, the kind of off-book that we did change in the quarter, this quarter's off-book was largely gold loan co-lending, and that went up from 176 crores at the end of Q3 to 522 crore rupees at the end of Q4. So that's about 450-ish crores that we've added to our co-lending book in 350 crores, beg your pardon, to our co-lending book at the, in the quarter. We expanded our distribution further by adding 12 branches in the quarter, taking our total branch count to 621. And while I did mention in the last call, since it's a Q4 event, I'll mention it again. We've received a rating upgrade. We are rated AA plus by CARE and India Rating, and CRISIL has assigned us a long-term credit rating of AA with a positive outlook. Finally, the ROA for FY24 is 2.4%, ROE is 13.5%. The corresponding numbers for Q4 are 2.5% and 12.2% respectively. So with that brief preamble, I'll open up for questions now, and we can discuss any aspect of the business you'd like me to amplify.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sneha Ganatra from Snud Life. Please go ahead.
Hello. Sir, just wanted to know, first question is, how do you see the growth going ahead, and any internal target of the mix which we are focusing, and in regarding the gold loan also, considering the continuous uptick on the prices, how the momentum on the growth part we are seeing going ahead for the next fiscal year. Second question is, what is the branch expansion strategy, and any internal target of the cost to income ratio which we are targeting, and any operating leverage benefit which we expect that could be occurring in the upcoming years also. And would like to know what is your guidance on the impairment cost going ahead.
All right, that's 5 different questions, and I'll attempt to answer them in order. The impairment cost, we believe on a sustainable basis will be something like 80 basis points. So that's what we are comfortable guiding. That is question 1. Question 2 is that we believe that from where we are, we should be able to comfortably grow at 25%, at a rate of 25% plus, and we will take advantage of any tailwinds that the environment affords us from time to time. Like in the previous quarter, we saw that the gold loan business had some advantages going for it, including an increase in gold loan prices. So that is something that we are comfortable guiding. Now, with regard to the mix, we are a lender to small businessmen, and we are seeing a far greater traction in our small mortgage business. That's also has the highest behavioral tenor of all our products. So, which is why, with the passage of time, it will continue to dominate our balance sheet. Now, the other 2 installment loan products that we have, which is medium ticket mortgage and unsecured, we have less than 250 people deployed to both these businesses put together. So whatever we originate there, we will warehouse on our balance sheet for 6 months, which is the minimum period, and 1 or 2 months after that, we will sell down. So that is the strategy pertaining to the other 2 businesses. You would have seen evidence of this in our investor deck, slides 24 and 25. As a percentage of on book, the small mortgage business is up from 24% to 29% in the current year, and that trajectory should continue in the foreseeable future. That's as far as the product mix is concerned. So I hope I've answered all your questions. Yeah.
Okay. So the current participant line has been disconnected. We will move on to the next question. The next question is from the line of Ranish from ICICI. Please go ahead.
Yeah, hi Anil. Congrats on a good set of numbers. Just two questions from my side. One on the disbursement yield side. So, we have seen across the bucket disbursement yield fell by almost 40, 50 basis point on sequential basis. So what is going on? I mean, since we are growing our AUM at 14%, is this because of that, or there is, let's say, increased competition is leading to the moderation in disbursement yield?
Okay. So the yields on a per product basis continue to hold, Ranish. Okay, whether it is gold loans or small mortgage or medium ticket mortgage, the yields on a or unsecured, the yields on a per product basis continue to hold. Any changes that we see are owing to the changes in the mix that we would have seen in the quarter. That's basically it. The second factor affecting yields as calculated would be the fact that we've embarked on co-lending for our gold loan business. So that is where we recognize interest income as the spread as opposed to the entire yield that we charge the customer. Or to give you an example, if the customer rate is 15%, okay, on the co-lend portion of the portfolio, we only recognize 15 minus say 9%, 6%. So that is the only difference. But otherwise, I can confirm that on a per product basis, the yields have held across the spectrum.
Okay. And second question again on the loss on the direct assignment portfolio. Now, does it mean that the asset quality for already assigned portfolio has deteriorated and hence we have to compensate for that, or how one should read the loss on the net gain on assigned portfolio versus 160 odd crore of net revenue last quarter?
It's 16 crores actually last quarter.
Yeah, sorry, 16 crores.
Yeah, so this is a net gain. So the way this works, and I'm sure you know this, is that on what you sell down in the current quarter, there's an upfront gain that you book.
Correct.
What you sell down in previous quarters, there's a negative to the portfolio owing to the unwinding of the gain that you booked.
Right.
Okay.
Right.
Now, in quarters 2 and 3, we had sold down a lot of our portfolio, especially because we were getting into an IPO, and the date of the IPO was far from certain. In the month of September 23, our debt equity had actually touched 5.8%. Okay, so we sold down quite aggressively in Q2 and Q3. In Q4, our appetite for off-book was met through the co-lending route. Okay, so which is why we only sold 284 crore rupees. Okay, so as a consequence of that, the unwinding and the upfronting kind of cancelled each other out. We had a negative of about 15 lakh rupees or so in that quarter. Okay.
Got it.
So had we stuck to the same trajectory of sell down as Q3, we would have made, let's say, 16 crore rupees more in the quarter. Okay, but from a commercial standpoint, it didn't make sense doing it especially because we were flush with funds post IPO and our co-lending arrangements had fructified.
Got it. And just last question from my side on the cost of borrowing front. So if you can throw some light on, let's say, the blended cost of borrowing for this quarter and the incremental cost of borrowing in current quarter.
Sure. I'll let Ganesh answer that. Our CFO, he will answer that.
Yeah.
Yeah. Hi, Ganesh. Thank you for the question.
Hi, Ganesh.
Hi. So, see, on an overall basis, as you would know, in quarter 3, RBI had increased risk weights on bank lending to NBFCs. As a result of that, there has been a small increase in our cost of about 10-12 bps in terms of the blended cost of funds. But that being said, post our credit rating upgrade, we have been able to tie up incremental commitments at rates reasonably lower than the blended cost of funds, which gives us confidence that slowly but surely the cost of funds, we have seen the peak and should start coming down from here.
Okay. Would you like to give the numbers?
It's not in the deck. I would be a little hesitant to do that.
Okay. No worries. Okay. No. Direction comment is very helpful, Ganesh. Thank you. That's it from my side.
Yeah. Thank you.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Mr. Shripal Doshi from Equirus Securities. Please go ahead. Okay.
Sorry. Hi, sir. Thank you for giving me the opportunity. So my question was pertaining to margins. So as you highlighted to the earlier participant that yields are broadly sticking where they were and COF is likely to have picked out. So is it fair to assume that we will be able to hold names at current levels? And if not, then what is the guidance that we have for FY25 and FY26?
So from where it looks right now, our customer yields should stay at the current level. Okay. The wisdom that we've received on the trajectory of interest rates is that the rate cuts will be more back-ended than front-ended during the course of the year, which is why we believe that our cost of borrowings will also stay sticky during the course of the year. Which is why we believe that our spreads will stay constant. The only thing that will increase the spread is that if we do more co-lending for gold, which is what we are in a quest for, our spreads might increase from here on. That really is the way this will work in the course of the current year. Of course, if interest rates correct sooner than we expect, then that's a benefit that we all have. The second factor I would like to overlay is that we have a large gold loan book and our ALM is positive right from the first bucket itself. So we have the loan to borrow short term. As of the end of March, we have zero commercial paper, zero short term borrowing. So I believe that before the long term interest rates correct, there will be liquidity and the short term interest rates will ease. That will give us a chance to borrow at the shorter end. So then, that could depress our cost of borrowings, resulting in higher spreads. So that's how I think it will pan out.
Got it. I'll come in the question. Thank you for answering my question.
Can I just add to that,
please. Yeah, sure.
See, in terms of new business originated, we have had a phenomenal Q4. In fact, we disbursed approximately 1,000 crores more than our best quarter till date. Okay, the only challenge was that much of that business was back-ended towards the end of the quarter, which is why when you arrive at a mathematical yield, there is an optical illusion there which suggests a meaning which is not actually there.
Okay.
When you see the income coming out of that in Q1 of this year, it may lead to a positive surprise.
Got it.
Okay. Also on the gold loan business, there are these twin headwinds, the twin tailwinds of the gold price rise, as well as one of the peers possibly going slower, which also explains why we have had a phenomenal the quarter for gold loan. I think the team is geared up to be much more aggressive in that product. So all of this gives us a lot of confidence entering the new fiscal.
Got it, sir. Got it. Thank you so much, sir.
Thank you, Shiva.
Thank you. The next question is from the line of Samir Bise from JM Financial. Please go ahead.
Yeah, hi. Thanks for the opportunity. Hi, Anil. Hi, CVG. Just wanted to understand or hear your thoughts, especially in context of the greater regulatory scrutiny with respect to the gold business. How are you positioned, and your thoughts on the same with respect to how tightening or how tighter have your processes been? Some details there would be helpful.
Sure. Hi, Samir. Thanks for this question. So FedFina has been doing the gold loan business since 2011, okay, and we've been audited every year since then. It's also pertinent to note that we are audited by RBI Trivandrum as opposed to RBI Bombay, and the large gold loan companies are all audited by RBI Trivandrum. Okay, so in audits year after year, our practices have got scrutinized, we've got feedback, and things have moved on. Now, obviously, recently there's been a lot of regulatory action, and there's been information coming in about what the regulator has said and what practices exist and stuff. So internally, we've also gone and checked as to where we stand to all this. All these issues have got discussed, and from our standpoint, got addressed several years ago, mostly pre-COVID and stuff. So all of what the regulator has said and which has been in the public domain in the months of Feb and March is really quite old hat for us, yeah. Okay, and we are reasonably robust from that standpoint. So our understanding of the regulations, our adherence to those regulations, as well as our execution of the gold loan business, where absolutely everything gets run out of the system, right from KYC to training people to auditing to managing the auctions, doing the auctions at taluka level, district level, the periodicity of those auctions, the fact that we auction on a per customer basis, all of that is done and dusted for us, and I'm happy to confirm that. Yeah.
Great. This is comforting. Also, just wanted to understand in terms of seasonality, how would the business look? Say, given that we had a very strong Q4 in terms of growth, you expect exceeding those in the near term in terms of disbursements, or you think that there could be a meaningful dip in the near term, given the way the business is shaped?
So our gold loan business has a few different variables which drive growth, one of which is the price of gold. And we saw the price of gold increase in the previous quarter. We believe that impact will last till the mid of May, given that we take the 30-day average of price of gold. That's regulatory how your lending rate is calculated. So the previous growth will trickle in to the middle of May or so. So we're in a good place there. The second thing, obviously, is the progress of opening branches. Okay, and we didn't open branches last year, and we intend opening a few branches this year. So that's the second thing that will take up our AUM. The third is obviously the productivity. Now, last year, our AUM per branch started at 6.3 crore rupees per branch, and we closed at 8.7 crore rupees. So we've had a ramp up in productivity. We've also had a ramp up in the amount of new gold that's come into our vaults over the previous year. Okay, so all of these factors, contribute to the increase in gold, increase in gold AUM. I believe that for the current quarter, there seems to be an upward bias in the price of gold, so that should contribute, and that should counterweigh the fact that seasonally Q1 is a weak quarter. The second factor is that one large player is still not disbursing loans. So whether it's Fedfina or anybody else doing gold, they will see some overflow of demand coming there. So Q1 will be a good quarter for gold based on all of this, but I don't think it will be comparable to Q4. In Q4, we saw an AUM increase of 556 crore rupees, I think, for gold. We won't see that kind of increase this quarter, but it will be a reasonably good quarter is my estimation.
Great, this is helpful. Thank you and all the best.
Thanks so much, Samir.
Thank you. The next question is from the line of Nirmal Bari from Nuvama Asset Management. Please go ahead.
Yeah, thanks for the opportunity. My first question is if you can give the slippage and write-off numbers for the current quarter and the full year.
We're just getting that, yeah. And while we get that, do you have a second question?
Yeah, actually, I would like to understand a bit more on the net gains on direct assignment. I understand that an earlier participant had asked the same question, and you said that unwinding of discount led to this. But an unwinding of discount should lead to a positive number being added, right? Because we are discounting that we were discounting that till Q3 in this case, and then that unwinding should add a positive number. Shouldn't that be the case?
No, I'll just explain giving you a numerical example. Okay, let's say in a certain quarter, Q1, you sell 100 crore rupees and you book a 10 crore rupee gain on sale. Okay, that is essentially the discounted cash flow of the future receivables, assuming a certain prepayment rate and all of that. You discount at a certain rate, that is your gain on sale. At the end of Q1, you say that this is what it is and that's the gain you book. At the end of Q2, what will happen is there will be some repayments, prepayments and stuff. Let's say your 100 crore portfolio comes down to 95 crores. Okay. Then at the end of Q2, you again estimate what the gain on sale, what the present value of your discounted future cash flows is. That number will obviously be less than what you estimated at Q1. Okay, because your portfolio is lower. Now that difference you charge off to P&L, and that is the unwinding that I was alluding to. So while you have a gain on sale in the quarter that you book the transaction, in every subsequent quarter you have an unwinding of that gain on sale, so that when the transaction gets nullified, you're done and dusted. So that's basically how it works. What happened in Q4 was that we did a lot of direct assignment transactions in Q2 and Q3 because, like I said, we didn't have visibility to the IPO and we wanted to secure our debt equity ratio. And that unwinding is what hit us in Q4. And the gain on sale just about compensated for the unwinding that hit us, okay, which is why it was a negative 15 lakh rupee as opposed to a positive 16 crore rupee in the previous quarter. Yeah.
And what was the total quantum of direct assignment done in this quarter?
The 284 crore rupees.
84 crores. Okay. And my final question is on the, again, data keeping question on the credit cost. If you can give split of current quarters and full year's credit cost between standard asset provisioning, NPA related provisioning, and write-offs.
Sure. First, I'll give it to you for for the entire year. Then for the entire year, we've had an ECL impact of 6.5 crore rupees. Okay. Write-offs of 73.6 crore rupees and a recovery of bad debts of 14.2 crore rupees. So the net of all these numbers is 65.9 crore rupees, which is the total credit cost that we've had over the course of the year. The corresponding numbers for Q4 are write-offs of 28.86 crores, recoveries of 3.3 crore rupees, and an ECL of 7.83, giving us a net of 17.73 crores.
And this 28.86 would include the large account that we had sold to ARC?
That's right. It would include the large account that we sold to the ARC, yes.
Okay. Yeah, thanks.
Yeah, thanks.
And the first question on slippage, if you can give that number as
well. We'll just get that, yeah. We'll go to the
sure.
question. We'll just get that. Yeah.
Okay, thanks.
Yeah.
Thank you. The next question is from the line of Pranav Gupta from Aionios Alpha Investment Advisor. Please go ahead.
Hello.
Yeah. Hi, Pranav.
Yeah, hi, Anil and team. Congratulations on a good set of numbers. A couple of questions on the cost side. So we have seen, overall OpEx remain sticky for this quarter. I mean, flattish if we compare it on a QOQ basis. Could you talk about two things? One, where we are in the journey of, transitioning into the sales force, and secondly, is this an indication of some of the operating leverage coming in, or is it just a function of the back-ended growth? That's the first question.
So I'll talk about Salesforce. Salesforce has gone live, and we did a pilot in 10 branches to start with. We will take 20 branches, to start with, and we are observing how it works, and then we will expand it to the rest of the business. Okay, so that's where we are on our Salesforce journey. Okay, and that has happened in the month of April. Okay, so that's as far as Salesforce is concerned. Now, otherwise, on our expense journey, we believe that our expenses will not increase significantly here on in proportion. Our expenses are directly linked. 90% of our expenses are anyway directly linked to origination and underwriting, and the platform costs are much smaller. So whatever expenses we incur have to do with origination. So the trajectory of these will ebb and flow with how much we originate. Now, for the year gone by, we were at a cost to income of about 58%, or a cost to asset of about cost to AUM of 5.2%. Okay. Now that is down from I think 5.6 a year ago. So we want to keep making progress on a cost as a proportion of AUM and improve that by maybe 30-40 basis points during the course of the year. Yeah, that is where we are.
So I'll just add maybe a couple of numbers from a quarterly improvement in OpEx here. See, as of quarter 3, okay, our OpEx as a percentage of average loan book has gone down in Q4 by 30 bps. Q4 over Q3. So OpEx as a percentage of average AUF has improved 30 bps. Okay, Q4 over Q3. Now, as Anil articulated, given that we have a program of selling off some part of what we originate, this improvement would be a little more material when you look at the OpEx to AUM. So there again, our OpEx to average AUM has shown an improvement of 40 bps quarter on quarter, Q4 over Q3. Right? Now, that being said, typically in Q1, you have employee-related costs, which is a step up in salaries and all that which come in. But the way these metrics are moving gives us confidence that we are on the right path and the trajectory is downward.
Right. So fair enough. Just wanted to understand two things, mainly on the other expenses bit. That's sort of remained flattish for the last 3 quarters or so, if I look at it on an absolute basis. Is this an indication that from here on we might see not that growth might not sort of match up to the AUM bit, and that's the first bit. Second is obviously we understand that given the fact that we are transitioning from having a slightly lower share of AUM off book to a higher share, cost to AUM will move down faster. But if you look at cost to assets as well, that's seen an improvement. Should one expect that improvement to continue through FY25 as well? That is what I was trying to figure out.
I didn't get your first question, Pranav. The second bit I did, but I didn't get your first question.
I'll just repeat it. So if you look at other expenses, the line item. The line item has sort of remained flattish over the last 3 quarters. From here on, should we expect that probably other expenses growth is in line with either expansion of branches or much lower than AUM growth, or is this just something that's stayed here for a bit and then will start growing in line with AUM again?
The largest component of our other expenses, there are two large components of the other expense line. Okay, one is what we invest on technology, and the second is the leases that we pay for our branches. Okay, now this year we've opened 50 small mortgage branches, so the expenses have gone up in line with that, and we've also done development of our new LOS, which is a Salesforce based. So those are the two items of expense that we've incurred. So next year we will open branches. So obviously the lease expenses for those will happen, but otherwise I think they will stay reasonably range bound. Yeah, there is no other head of expense that will increase. So our other expenses are linked to, you can say, branch expansion, and that's the only thing that will impact this over the coming year. Yeah. Your second question was about cost as a percentage of assets. The trajectory of costs will not change, will not increase as quickly as the trajectory of assets. So we should see this coming down also, just the way cost as a proportion of AUM will come down. Yeah.
Perfect. Thank you so much. Just one last bit. Could you give the breakup of other income?
The breakup of other income. No, I will just tell you what this other income includes.
Sure.
Broadly, it is income that we get for distribution of Federal Bank products, and marketing activities that we do. Yeah. Profit on sale of GSECs, net gain on fair value charges. So all of that is what other income is composed of.
Sure. Okay. Thank you so much.
Yeah, thanks. And I have the breakup of our credit costs. So we started the year with a credit with a stage 3 of 164.5 crore rupees. We added 116.9 during the course of the year. We reduced 89 crores and wrote off 26 crores, and giving us a closing balance of 165.28 during the course of the year. Okay. So between last year and this year, we've added less than 1 crore rupees to our stage 3.
Okay, thank you. The next question is from the line of Kunal Khudania from DSP Asset Managers. Please go ahead.
Hi, this is Vivek here. My question is on the cost to income. I joined the call a little late, so sorry if you had already answered it before. Is there a cost to income ratio or a cost to AUM ratio that you're guiding us to? And or another tricky way of asking the same question is, for a mature branch, what would be the cost to income or a cost to AUM?
Okay. For the year gone by, we had a cost to AUM of 5.2%. Okay. We believe that in the coming year, it should be better by between 30 and 40 basis points. Okay. So that is the answer to part 1 of your question. Part 2 of your question, we do have metrics depending on the kind of branch that we have, but the metrics are not cost to income. Okay. They are more about the absolute cost that we want to incur in each branch in relation to the AUM of that branch. And these are different for different kinds of branches. There are gold loan branches, non-gold loan branches, there are historical branches in South India which were architected to be of a certain size, and rest of India branches are a little bigger because the AUM per branch rest of India is a lot bigger. Okay, so there are different dynamics pertaining to this, but to abstract this at a slightly higher level, I think how you should look at us is that we were at 5.2% on a cost to AUM, and that should improve by 40 basis points during the course of the year.
Okay, thank you very much.
Thank you.
Thank you. The next question is from the line of Harshvardhan Agrawal from Bandhan AMC. Please go ahead.
Hi sir, thanks for the opportunity. So just wanted to understand the amount of sell downs that you have done in 2Q and 3Q. This is just to understand the negative DA income that you have got. So just to understand that flow, if you can help that.
Yeah, you'll find this on slide 40 of our investor deck. In Q2, we sold down 527 crores. In Q3, we sold down 457 crores. In Q4, we sold down 284 crores.
Okay, so basically this 1,000 crore roughly that we sold down was yielding us 15 CR income on a quarterly basis. Is that correct?
No, that's not. Well, each quarter there's a gain. We disclose the net gain on sale that we get, which is upfronting minus unwinding. For Q4, those numbers exactly cancel themselves out.
Okay, so basically this 284 CR would have given us around 15% CR of gain.
Sorry, if you could repeat that, yeah. You're not very clear, Harsh.
Sorry. So what I'm trying to ask is, this 285 CR that we sold in 4Q would have yielded us somewhere around 15-16 CR, and the unwinding of that 1,000 crore of the previous year was around 15-16 CR.
Okay, one sec. Okay. Yeah, the upfronting during the fourth quarter was 16.5 crores. The unwinding was about 18 crores. So that's how we got a negative 1.5 crores.
Okay, fair. Great. Thanks. And I guess.
Mr. Harshvardhan, does that answer your question? Should we?
Yeah, sure. Thank you.
Thank you. The next question is from the line of Mayank Mistry from JM Financial. Please go ahead.
Yeah, hi sir. So my question is on the average ticket size of medium ticket LAP, which you have mentioned on slide number 18 as 67 lakh. So basically, last quarter it was at around 49 lakh, which have increased significantly to 67 lakh. So what explains this significant growth? I mean, is there a major sell down, or is it only on the fresh dispersal? That can you please explain on this?
So what we did was, we previously used to restrict this business up to a ticket size of about 1 crore rupees. We now let them go up to 2 crore rupees. Yeah. Okay. So that is what explains this inflation in ticket size between the last two quarters.
So this is on a blended this is the on-book average ticket size of medium ticket, right?
That's right.
Okay, fine. Thanks.
So Mayank, I'll just come in here. See, the point is, when you originate, it is always on book, right? But typically, I think we have a stated policy or strategy that we keep the higher yielding assets on books, and the lower yielding assets, we originate higher ticket sizes where we see appetite for an onward sale, and we optimize on that. So obviously, after a seasoning period, as required by the direct assignment rules, these would be available for sale, and which opportunities we would capitalize on based on the wide array of partnerships we have, who have the appetite to buy these.
Okay, got it.
Thank you. The next question is from the line of Arvind R from Sundaram Alternates. Please go ahead.
Hello. Thank you, sir. Thank you so much for the opportunity. I hope you can hear me. So, the ECL provision as the percentage of assets across stage 1, stage 2, and stage 3, I can see that right now it has declined a bit. I wanted to understand, are we comfortable with the current levels, or do we want to fortify it to the FY23 or above levels? That's my first question. And second question is on what would be our branch addition and employee addition plans for gold and non-gold branches, non-gold businesses. And a third question is on the other income. What are the potential opportunities we are seeing in terms of other income, say cross-selling, insurance products or any other third-party products? Is there anything addition to whatever we are doing now? Do you see any significant opportunities in the coming years? Thank you.
Yeah. Hi, Arvind. We have applied for a corporate agency. We will get our license hopefully in the month of May or June. And at that point in time, we will use our distribution network of gold and non-gold branches to also sell insurance. We currently don't embed insurance with our gold loan customers, and health insurance, life insurance are products that we can cross-sell to these customers. So that's an opportunity that is there. Now, number two, with regard to the ECL provision that we have, so on stage 1, stage 2, and stage 3, each of our products, we continue to maintain the same provisions that we used to previously. So any changes that you see is owing to the mix. It's also owing to the fact that our gold loan has had a stronger growth than the other products in terms of AUM, and the ECL provision required on gold loan, especially for stage 2, is for stage 1 is negligible.
Okay.
Also on stage 3, what has happened is that we sold one large account to the ARC that was provided to the extent of 53 or so %. Okay. So given that we sold it off, the provisioning also has corrected itself. On stage 2 accounts, we used to have a restructured book at a point in time, okay, where we used to provide as per stage 3 kind of levels. Now that book also has more or less gone, which is why the provisioning for stage 2 has come down. So these are the different variables that impact provisioning, but otherwise, on a product by product basis, we continue to be provided as we used to be. And you may recall that at the end of Q3, we actually took up our provisioning for mortgage loans from 19.5% to 23%. That's for stage 3 loans. Okay, so that's the migration in stage 3. Finally, you spoke about our plans to grow and expand. In the coming year, we want to open about 50 gold loan branches and 30 small mortgage locations. So that is the plan for the year, and we will execute it, try and front end that during the course of the year. That's the intent.
Sure, sir. Any color you can give on which region it would be, these branches, or is it distributed throughout the country?
So the approach that we followed is to try and grow efficiently this year, which means that we are not opening any new regions, okay? Because a new region is overheads in terms of regional leadership and all that. So the branches that we've identified will add up as 4, 5, 6 branches in each of our existing regions for gold loans, and ditto for our non-gold businesses. We already have leadership built out. So the branches, these are only production related expenses that we will incur in terms of people and premises, and that's a more efficient way of growing in the current year. That's our thinking.
Sure, sir. And just one last question, if I can squeeze in. I'm sorry if this question
has
been already answered. Yeah, what would be the credit growth of guidance, either segment wise or the overall? Is there any guidance on that?
Our cost of credit, you should assume 80 basis.
No, credit growth.
Credit growth.
Advances. Yeah, advances growth. Yeah.
That I've already guided 25% growth. And we should try and top that if there are tailwinds like there were in the previous quarter.
Sure. Thank you. Thank you so much.
Thank you. As there are no further questions, I would now like to hand the conference over to Mr. Sripal Doshi for closing comments.
Thank you, Steve. I would like to thank the management of Fedbank Financial Services for giving us the opportunity to host the call. And thank you to all the participants for being part of the call. Thank you all and have a good day.
On behalf of Eureka Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.